Hi, I'm Bill Pierce. I work with the Overseas Private Investment Corporation, or OPIC. We're the United States Development Finance Institution. Did a quick change. Actually, my title has changed since last time I did this a year ago, so I'm now Deputy Vice President of Investment Funds. Well, thank you very much for having me and moderating this. We have a very august panel today. What I'd like to do is go down the road. Everybody can introduce themselves, what they do, and what is their interest currently and in the future in Africa. So, Suzanne, would you like to start first?
Thank you. Glad to be back at Africa Investor. It's always a good venue for catching up with Africa. I'm the director of the Investment Management Division of the United Nations Joint Staff Pension Fund. We are the world's most global pension fund with investments in every member state, and we're up to 194 member states. We were very early, and fortunately early, to invest in Africa in private equity, real estate, and publicly traded equity, as well as fixed income. So we're broadly invested across all asset classes, and happy to be here to get another perspective on a very growing market.
Thank you, Bill. My name's Ashley Bendell. I run the New York office of African Alliance. African Alliance is a Pan-African investment group. We're in 12 countries across Africa, and we have an investment banking asset management business as well as a private equity firm. We develop property across the continent and also run an insurance group and an SME stroke retail bank across Southern Africa.
Yes, Ed Mathias with the Carlyle Group. We're a global asset management firm with over $200 billion. I think we were the first global firm to establish a foothold in Africa. We have a $700 million fund that we started about a year ago. And I guess on a personal basis, I should say I've been quite involved because my wife was instrumental in doing Power Africa for the Obama administration, and we're probably the only U.S. investor. I'm probably the only U.S. investor that has a house in Nairobi. So,
thank you, Colin.
Colin Coleman from Goldman Sachs. I'm a partner, been with Goldman for 14 years. I have 4 children. Great to be back here. Goldman Sachs is active in principal investing, in advising, in financing, in asset management, really across the board in Africa. We're active really through South Africa, Nigeria, Angola, Kenya. Nigeria would be the sort of main markets, with Mozambique and some of the oil and gas discovery countries featuring more strongly in terms of the travel patterns of the Goldman Sachs people. But that's broadly what we're doing.
Thank you, and I'll round it out by letting you all know what OPIC does, particularly in Africa. We are an independent government corporation. We are self-sustaining. We actually make money and give back money to the taxpayers, U.S. taxpayers. We have about $18 billion of commitments outstanding, broken out between structured finance projects, which are the big ticket debt finance deals, SME finance, political risk insurance, and the department I work in, which is investment funds, where we have about $2 billion committed to private equity and credit funds around the world. And Africa is probably our largest exposure. About over 30% of that $2 billion is committed to Africa. And we've been in Africa for a while, even back in the 90s, when, in the very early days, when there really was no private equity in Africa, or even it was just starting even around the world in emerging markets. So we continue to have Africa, Sub-Saharan Africa particularly, as a focus, and I think it's now become one of the, if not 25% of OPIC's exposure and commitment, and growing. And as you know, we're also very much involved in the Power Africa initiative that Ed and his wife have, Ed had mentioned his wife has worked hard on, where OPIC has committed about $1.5 billion, or to put $1.5 billion to work in generating as well as distributing power in Africa with a focus on renewables in the next 5 years. So with that, let me go straight. You can ask further questions later. Let me go first straight to asking questions of our panelists. I will start with Ed, but what I will do, though, is also has one overarching question I would like all of you to answer in your responses, and that is sort of the purpose of this panel, is what, in your opinion, are 3 things that the World Bank could do to support the creation of a pipeline of SME IPO prospects to deepen Africa's capital markets? As a private equity person, I'm actually very interested to hear your responses because we are concerned about our funds exiting, which it takes a long gestation period, and I'd love to hear your comments. But Ed, so that's the overarching question for all of you to answer. And Ed, I'd like to ask you first, just tell us your experience in Africa now and how your first fund has done, and congratulations on beating your targets.
As I mentioned, we have $700 million fund. For all the reasons you're aware of, we see this as an area of opportunity. While we have $700 million earmarked, we have the ability to draw on other funds if bigger deals come up. Let me just comment on several of what I would call our learning experiences. The first would be fundraising. Initially, we found huge amounts of interest in the U.S., but no investment. The pension funds and others, it's just very, very early. And finally, we raised half the fund from both Africa and Europe, and then half in the U.S. from a bank that went and got individual investors. So the point I would make is there's a lot more interest among individuals to actually invest. There's a lot of interest in terms of institutions to learn more about it. But we're still very, very early in the U.S. investment cycle. We see it as a very diverse continent, of course. Our efforts are focused on the largest economies, Nigeria, Kenya. We've done a deal in Tanzania. We've done a deal in Mozambique. We've learned that you can't superimpose the U.S. model on Africa. The idea that you can go in and just do control investments, quickly get them done, quickly sell them, and say it just doesn't work. It's a long, long process and quite different. We have to tailor to each individual deal, and we also have to be very, very careful and conscious of who our partners are. Suffice to say, it's much more competitive than people see. We found when there are not that many deals that would fall into our purview, and where there are, there's lots of interest. As a model, and the other firms differ somewhat, each of the major what I would call buyout firms has a different model for Africa. Some have a single fund that they operate from around the world. Some are trying to do it from the European entity. We have chosen to have a local presence and have a specific fund. And the time and complexity of deals is really quite pronounced. It takes us roughly a year to close a deal. And we have to be very, very conscious of things like the Foreign Corruption Act. So in some ways, we're forced to put U.S. standards on a continent where it doesn't actually apply. And then finally, a lot of the deals just require immense amounts of work afterwards to bring in the financial structure, to work with the managements. And the one area that we have found that gives us something of a competitive advantage is that we have a global footprint. And what most of the companies want is sales. And hopefully we can help them sell through their through our other entities around the world. But as I said, we've made 4 investments so far: ETG in Tanzania, J&J, which is a trucking company in Mozambique, Traxxas, which is a company that is not based in Africa but does a lot of mineral and mining business there, and finally we participated in Diamond Bank. And I would say each of them has a very different structure and a very different set of characteristics that we've had to tailor to the market. So,
thank you very much. Appreciate it. Ashley, can you go next, please? Oh, also, Ed, just want to ask, just if you had thoughts on, what are the things that the bank could do or others to help support more pipeline of SME IPOs?
Want me to answer that now?
Sure.
Okay, I will. There was a very famous movie in the U.S. Called The Graduate, where when the fellow was getting out of college, somebody whispered in his ear, the key to the future is plastics. I mean, to me, the key to the future and overrides everything in Africa is infrastructure, very broadly defined. I mean, at the previous session, they were talking about power plants and other forms of infrastructure, but it's also financial infrastructure, communications. It's a very broad subject. So I would say It's kind of a circuitous argument because you need economic growth requires infrastructure, and infrastructure requires economic growth to pay for it. So how do you break the chain? I think there's two ways. One, I think financial institutions like the World Bank should be borrowing every penny they can right now when rates are so cheap. They're basically, in some ways, giving money away if you have a AAA credit, and invest it. And Larry Summers had an article in the FT yesterday, I think the day before, about how infrastructure investment pays off. So the one thing I would do is ratchet up the investments while you have the money. And secondly, on a private basis, risk mitigation is very, very important. So if you can take some of the risk out, either through guarantees or putting the first money in, you get a huge amount of leverage from your efforts. And I noticed the last panel, they talked about the balance sheets of governments and all. I mean, in terms of the U.S. balance sheet and the European Union and the World Bank and the IMF, these are peanut numbers. And they should be willing, I think, to put a lot more money to work.
Good. I appreciate that. Ashley.
Thanks, Ed. Thanks, Bill. Yeah, I've been asked to talk about sentiment around the local stock markets and the private equity markets, which has certainly changed since I moved to New York in 2006 with Credit Suisse at the time. About a year after that, I moved to a smaller boutique firm to focus on the African capital markets, and I've been doing that ever since. I think pre-crisis, there was a lot of interest in the IPOs in Nigeria. People were looking to the emerging markets quite aggressively and not asking too many questions about where Nigeria was. They couldn't necessarily place these countries on a map. It was fascinating as I sold IPOs across Eastern Europe to US investors and overlapped with some of Africa and South Africa. So that was 8 years ago. I think the market has changed tremendously post-crisis. And about 7 years ago, you started to see some sub-Saharan and frontier funds launched. At that time, there were very few. Emerging Markets Management, a firm here in DC, was one of the first proponents of emerging markets and Africa publicly. And that firm has since spawned a few other firms that invest in Africa. You've seen a lot of interest out of sub-Saharan funds now launching, but that has spurned a number of frontier funds. The BRIC markets 2 to 3 years ago weren't performing particularly well. Growth was obviously more subdued, and investors were ultimately looking for greater yield and greater stock market returns elsewhere, as growth in Africa surpassed them quite substantially. So you've seen these funds, both sub-Saharan and frontier, launched by some very large institutional fund managers and funds that have separated off from them, come out of South Africa quite significantly, as a number of funds themselves look to get exposure into sub-Saharan Africa. You've seen a lot of launches in Europe, Germany, Scandinavia, and London in particular, and America, which is the market that I focus on. Not just out of the tri-state area in the Northeast, out of Chicago, San Diego, Seattle, and Miami. And that sentiment is still very positive. Like, we're all here, and Hubert's done a fantastic job of bringing us all together, and an increasing number of people over the years as I've been doing this, because Africa has become hot, in inverted commas, right? And I don't have to sell that story. What are people looking at? They're looking at not just Nigeria, they're not just looking at Kenya, the biggest stock markets outside of sub-Saharan Africa, that have had a fantastic run over the last couple of years. They're up about 100% each. Kenya's outperforming the rest this year, up about 25%. But what you're starting to see is investors now with slightly greater risk appetite towards the rest of Africa. They're looking at the Ivory Coast, the BRVM. They're looking at Ghana. And I'll talk about the trends because John isn't here in a second. They're looking at Tanzania because foreign ownership restrictions just came off, and we're taking a number of investors there to Dar es Salaam in about a month's time. Amongst other markets, Rwanda. I IPO'd Bank of Kigali a couple of years ago, the largest bank there. And then Southern Africa. Zimbabwe's been on the tip of a lot of people's tongue this year as well. And I think sentiment around that country is improving with the IMF starting to focus on it a bit more closely. I'll also just mention the private equity side. I think we've touched upon it, obviously, with Ed being here. There are a number of significant players in the space that have been doing Africa for a while. Carlyle and some of their major peers have now got into the market and raised significant capital. And I think that ties into the next point about what the IFC and World Bank can do, and ultimately working with the private equity firms and the capital markets community to incentivize firms and stock exchanges to list companies in Africa, which really hasn't happened in great shape or form over the last 6 or 7 years. You had Safaricom, Vodafone out of Kenya. Of late, you had Seplat, a $2 billion oil and gas company out of Nigeria, co-listing in London. But we really haven't had enough significant listings. And I think the likes of African Alliance, who work across Africa and across all of these, we have more stockbroking licenses than anyone in Africa. It's ultimately up to us and our private equity partners and companies to work together with the stock exchanges to make this happen. But ultimately, they need to incentivize companies to do it. The governments have been talking for a long time about privatizing business. And yeah, as I said, it's about the community coming together to provide the right type of advice that these companies ultimately need.
Are there any, now you mentioned, any specific incentives you think could help in getting the market moving at this point? Or is it a matter of just breaking regulations, breaking through?
Well, I think money talks, ultimately. And if you can, as many stock exchanges do, they provide a slightly better tax incentive to companies once they list. I think that's certainly something which they're focused on. I think what you also have is a lot, Africa's, well, not unique, but there's a number of very successful and large family operators across Africa. And obviously, once you list your financials and a lot of information about your company becomes public. And the feedback that we often get is that they don't need to list because they've become successful and want to keep their cards quite close to their chest still. So it's a back and forth negotiation, so to speak, with the stock exchanges. And I think a lot of them are actually quite forthcoming and willing to make something happen of it.
Thank you. Thank you very much. Colin, what is your take on Africa right now, and maybe you can tell us about some recent transactions you've been working on?
Okay, I'm pleased you've changed the question, because the first question you asked me was definitely a trick one. The combination of IPO and small and micro enterprise in the same sentence, and then adding in the World Bank was too much for my mind. But it leads to the same conversation, which is, I think it's actually pretty dynamic what's going on in sub-Saharan Africa, outside of South Africa. I would say, from a Goldman Sachs perspective, sub-Saharan Africa, excluding South Africa, is going to contribute to our revenues in a real way this year in ways that it hasn't in previous years. We've done a variety of bond transactions. We did the First Bank Nigeria, Zenith, and Access Bank bonds. This year we advised IHS on the purchase of MTN Nigeria Towers. We're advising several private equity funds on exiting portfolios in some quite meaningful transactions outside of South Africa. And the combination of this tells you what's happening on the ground. What's happening on the ground, I think, is that the private equity community, and I know it has its frustrations, for those who are putting capital to work, it probably doesn't go as fast as they'd like. But the fact is that the more the private equity community, the investing community, I see Chris Dirksen from Investec Asset Management here, for example, the more that multinational companies like GE and others get involved in the continent, the more that there's effectively going to be transaction flow. And that is certainly true. I think the first wave of investing is probably the private equity community, and that's why you're seeing a lot of the Helios Actuses of the world who are early to the game, ECPs and so on and so forth, getting into transactions, getting out of transactions, which also raises the IPO point, which is right now you've got primarily strategics as the sort of exit mechanism for transactions, whereas actually what you want is you want much more capital market opportunity and optionality. So when you mentioned the IPO environment, I went immediately in my mind to Angola because, and I don't know, is there anybody from Angola in the audience? Maybe not. But I was in Angola last week talking with the central bank and others, and they were telling me how they're getting ready for capital market issuance probably in the course of 2015, but very much focusing in the first instance getting the regulatory and the institutional capacity in place, and then starting off focusing on the debt capital markets less than the equity capital markets, and getting that sort of trading confidence going. And I was encouraging them because if you look at the Goldman Sachs history in China, for example, we helped to create the Chinese capital markets, and they issued probably $120 billion through the state-owned enterprise privatizations in the last 30 years. And if you think about a place like Angola, you think about Unitel, you think about Sonangol, you think about Endiama, many companies that are effectively private companies that are substantial, that Angolan citizens cannot access directly, that institutional investors cannot access, and the promise of those sorts of companies at some point being on the capital markets would be very differentiating for a place like Angola. You would suddenly be able to trade, you would be able to see their quarterly performances, they would be much more transparent, there would be a lot more focus on the governance, and it qualitatively improve the environment for people to actually participate, both for locals and for internationals. So I think that is a let's say epochal challenge. It's, you know, if it's not the next 5 years, it must be the next 10. If it's not the next 10, it should be the next 20. So in the human history landscape, that's a short-term horizon. In the short-term horizon, we should be seeing much more capital markets creation. The fact is, South Africa still is the only place where there's liquid capital markets on the continent. And so if you wanted to trade, you have to trade in and out of the JSE by and large, and until those capital markets become more liquid. Look at Nigeria. Nigeria trades effectively $20 million a day. The JSE trades $2 billion a day, and it has a market cap of 80 billion. The Johannesburg Stock Exchange is approaching $800 billion market cap. So that is a big change that has to take place. The sovereign wealth funds, the private equity players, the multinational companies, all getting much more robustly involved is a fantastic early sign of those pressures building, because over time, you know, the logical thing is the people in the countries where these businesses are being built are going to want to participate. It's a bit like, you know, MTN has the pressure to bring indigenous people into MTN Nigeria, and so they have that localization program, but it's very liquid. It's sort of, it's not really satisfactory over the long term, either to MTN or to the local population. So you'll have to see those sorts of things develop over time. So I think it's quite exciting, but I must say it feels to me like Africa is neither sort of the famine and dust bowl of old that we sort of saw in the time and the media, nor is it the China absolutely going to happen, you know, 20 years on. It's somewhere in the middle. There's this hybrid sort of contestation for what Africa is going to become, but it's very exciting to be part of it.
Thank you very much, Colin. I'll introduce John Neupel. Thanks for joining us, John. He's a managing partner at SQM Frontier Management, I believe still across the river. Yes, right. Thank you for joining us. I'd like to maybe, if you can quick give a sense of what you do, because you've been one of the first pioneers about 20 years ago, if I remember correctly, in the capital markets in Africa. To let us know what you're doing now, and then if you could also let us know what you see trends are the next 12 months for investors. That would be very helpful.
Okay. Thanks very much. Sorry I was late. I guess SQM is an institutional investment firm. We manage money in Africa and the Middle East, and I focus on Africa. We focus on investing in all the stock markets outside South Africa, so all the difficult ones. I guess the reason for asking me to be here, I guess, is because I've been doing this for quite a long time. I worked at another firm called Emerging Markets Management, where more than 20 years ago we started the first fund to invest in markets in Africa. The IFC was one of the supporters of that fund. Along with a lot of other institutional investors. So I guess my what I would like to sort of talk about a little bit is really what's happened over those last 20 years, and there has been things change slowly, but in over 20 years things have changed a lot. So 20 years ago, it was very difficult, virtually impossible to try to get someone to even contemplate investing in Africa at all. There were a few kind of pioneering investors that wanted to invest in that fund then, which was $30 million to start out with. It was the first fund, I think, at that point. But over time, you know, and at that point there was only 4 markets that were investable. Now there's, you know, 15 plus outside South Africa. And now we have kind of a problem, an inverse problem. Now it seems like there are a lot of people that want to invest in Africa. There's a whole slew of investors that now include frontier markets as part of their mandate, and as such they include Africa. There's been quite a few funds that have been created now. There's probably, I don't know, Ashley, how many funds? 50 plus, probably. There's lots of funds. There's lots of interest where there were no funds and no interest 20 years ago. Now there's lots of money. The problem in today's African capital markets on the equity side is that the markets are too small. All the markets in Africa put together, even if you include, you know, the North African markets of Egypt, Morocco, Tunisia, the market cap of everything outside South Africa is about 250 billion. That's smaller than Microsoft. So one company here, one sort of, and that's not Apple, that's Microsoft, which is pretty big but not gigantic, right? And the trading volume is about 5% of what trades in Microsoft in terms of value, how much trades. So the universe is still quite small. And so I think what we've seen over the last, you know, couple of years is that there's been more and more funds getting created. There's been more and more brokerages created. The whole infrastructure is there, but there have not been that many companies to go public. There's not been that much capital raised in our part of the world. There's some, and there's some movements in that direction. In Tanzania, they just opened up the market to foreign investment. In Zambia, they're going to force some of the companies that are already listed that to sell more shares in the market. There's a little bit of that, and we hope that there'll be some more IPOs coming to market. But I think over the next 5-10 years, you'll see this area grow, but it'll still be, you know, it'll continue to be a slow-moving thing. I hope, you know, my sort of hope 20 years ago was that, well, if we can invest in this place and we can make money for people, and that, you know, the return that a pension fund in the US or the UK or wherever, or university, that return in Africa could do as well as emerging markets or some other place, then maybe some people would start to get interested. Now that's been proven right. Investments in Africa have done as well, if not better, than they have in other parts of the world. Now there's all this interest, and so now I think it's just a matter of you know, letting the markets work, and hopefully more countries will open up markets. Hopefully more governments will encourage companies to go public by doing things like reducing tax rates for companies that are listed than if they're not, that kind of thing. And hopefully these markets will get kicked off a bit more, and once they are, then, you know, the borrowing cost comes down for everybody that's operating in those countries. So that's really my
Quick question to follow on.
2 cents.
Have you seen any, in your universe, are investors asking any risk premium for Africa vis-a-vis other emerging markets, or not these days?
Not exactly. I mean, yes and no. I think that the emerging markets themselves are a bit more interesting to investors over the last 2 or 3 years. They haven't been as interesting. Partially, you know, the big markets are largely driven by commodity-oriented companies. So emerging markets has become less, I don't know what you want to call it. When you invest in emerging markets, you want to invest in consumption and consumer plays and these things, you know, where in countries where people, you know, the average consumption of this is much lower than it is in the U.S. or in other places. And in a lot of the stocks in the emerging markets universe are no longer fall into that bucket. It's the small caps, mid caps, and frontier markets. So we've seen a huge amount of interest from people just wanting to invest in those kinds of companies.
Thank you very much. Suzanne, You'll save it up for you to give us your perspective from the UN's point of view and joint funds.
Well, I guess as a pension fund, we have a fiduciary duty to give the proper return. It's our sole interest in life. So we invest globally, and fortunately, my predecessors had the wisdom to invest in the early emerging markets funds and have profited, steadily over the years. In the last 5 years, since I've been with the fund, again, the African part of our portfolio has been among the fastest growing side. You look at the numbers and you know there was a financial crisis, but maybe it didn't happen in Africa. The developed markets really were the ones that suffered the most. And here, when we look at some of the discussions today about, not enough companies trading, not enough liquidity, why are there not listing these family-owned companies? I think they see what has happened in some of the European exchanges, and a family may not want to rush into an IPO. But perhaps that is going to happen now that the returns on the stocks are starting to look very tantalizing. And they're generational issues. As the family patriarch looks at his family growing, the best way sometimes to distribute it is with an IPO. It's a great family exit plan too. So long as the legal, accounting, and governance structures are ready, I think that Africa's on the eve of more listings, and that will be the exit plan for more of these private equity companies that are in the pipeline now. The other issue that I think has been a barrier to private equity and investment is the age-old issue of infrastructure. It is so hard to get from one coast to the other and around compared to if you're traveling in the US or Europe. This will change, but infrastructure investment is incredibly expensive. And as a pension fund manager, I look at the horrible risks that my kindred spirits and other pension funds have borne in the developed world. There's a big alignment of interest problem everywhere. If a country doesn't want to invest in its own electric transmission or subway system, how is the foreign investor ever going to be paid for doing that? I live in New York City. They planned the 2nd Avenue subway in 1929. It's not done yet. You have tremendous risk whenever you build something from the green field, and there's a lot of that to be done in Africa. So I'm hoping that with some cooperation among the governments and possibly some additional work from World Bank and IFC support, that the world can come up with a better mechanism to fund infrastructure. Because again, this is not just a problem in Africa. My neighbors in Canada lost a whole lot of money in European infrastructure over the last couple of years. Because guess what? They bought energy transmission pipelines and systems in Norway. And the taxpayers didn't want to raise the rates when the costs went up. So suddenly the cash flow was not as was forecast. So again, Norway is a wonderful, safe, developed country. If you don't make money in energy transmission in Norway, where in the world are you safe? So the baggage of the developed world comes with us when we look at infrastructure investments in Africa. And I think the world leadership has a lot of work to do to find out a way that a foreign investor can be protected enough to take the business risk involved in these activities. Because that's the one missing link to many economic prospects throughout Africa. Until you have reliable power, these wonderful electronic payment systems like M-Pesa, ingenious, brilliant, and it works. It doesn't work if you can't charge your phone. So let's work on the infrastructure. Let's get our advisors in the World Bank to come up with some guidance. We want something that works in Norway as well as in Africa. Because, in fact, I'd like to see the 2nd Avenue subway finished in New York, too. So let's work on that, and I think we'll solve problems for everybody. Thank you.
Thank you very much. That was very good. Thank you. Well, I'm conscious of time, And you've heard from all our panelists, and I'd like to open up for questions from the audience. Yes.
Good afternoon. This is Most Enlightening. My name is Donna Sims Wilson, and I am the new president of Smith Graham and Company, a $6 billion asset management firm headquartered in Houston, Texas. My question has to do with debt capital markets in Africa. There's been a lot of talk about the equity capital markets, but you've seen a growth in African countries accessing the global capital markets for their sovereign debts. I was wondering, could you talk about that and using Eurodollar bonds for infrastructure and international investors such as me to have access to those bonds? Thank you.
It's a good question. As I mentioned, we've done several bond issues of late in Nigeria, but I think one of the, and probably what you're referring to, is that the issuance of sovereign bonds has really taken off, and that's good and bad. It's good because there is the creation of vehicles through which you can participate in the development of these countries. It's bad in the sense that many of these countries are actually not in a great position to be continuing to issue, and there's a potential overheating relative to fiscal ratios. So, for example, and I'm not picking on any country, but Ghana, for example's fiscal ratios are obvious to everybody who's looked at them, have significantly in the last few years. And so whilst the capital markets and countries are taking advantage of the capital markets, that the word was used as hot, and they're certainly hot, we have to be cautious that they're not, that there's not an exploitation of this new hot, sudden environment for capital market issuance, and then we get back to these countries becoming overly indebted. But the fact is that there are good and bad stories in relation to the use of those bonds. So are the proceeds of these bond issuances being used well? Certain countries they are, particularly for infrastructure rollout. But I would just sort of advise caution, have a look when these bond issues are issued from the sovereigns as to what is the fiscal position of the sovereign, what are the credit rating agencies saying, what are the countries saying about the use of proceeds, and what's the track record of implementation. Just finally, if I might, Bill, I just wanted to make the point that when we think about what are the main obstacles to Africa meeting its potential right now, I think the fact is that we've got the wind to the back with all of these countries, China, South Africa, everybody behind the growth of Africa, multinational sovereign wealth funds, private equity. But it's really up to the countries themselves to take advantage of that wind and make it work. And the question is, where does it work and where doesn't it, and why? And obviously, political will is key. So are the Nigerians really going to implement power reform and really get the generation capacity built? And are they going to take advantage of Power Africa and so on and so forth? And then the question, separate from it, is are they in a position to do it? And so that brings you to the institutional capacity building. But I put it in that sequence because if there's no political will to get it done, or there's superficial political will to get it done, then it won't happen. If there is the political will to get it done, then the question becomes, do they have the capacity to get it done? And often you trip over the first question, get past it to the second question, but on the second question you trip over that. So you don't get the implementation. So to your question of what the World Bank should be doing, they should be doing three things: institutional capacity building, institutional capacity building, institutional capacity building.
I love it when a question generates many other questions. Ed,
Yeah,
you want to add to that?
This is something of a tangent, but it relates in that one of the issues that hasn't been mentioned is currency volatility. And if you're a U.S. investor or a European investor and you're exposed to some of these currencies, it can be a major, major factor. And I think the Rand would be a good example. And what we see in some of these markets is that the obligation is denominated in one currency and their revenues that it's dependent upon are another one, and that can be a vicious cycle. So we haven't found a way to hedge currency, but it's something that has a huge impact that we have to think about. I don't know, you probably see the same.
Yeah, no, my quick point on the debt question. I think it's remarkable how yields have contracted, right? Nigerian Eurobonds, when you talk about hedging against the currency, you've obviously got local sovereign debt and Eurobonds, which are increasingly popular by emerging markets managers still chasing that yield. Nigeria, 5%. I think the Ghanaian government were extremely happy to get off their $1 billion Eurobond a couple of months ago at 8.125%. President Mahama himself stated quite a few times during UN week that he was very happy with that. But I still think it's quite interesting. I was having a conversation last night with a US fund manager that invests in emerging markets that is starting to look at Africa. And I still, and just continuing to see interest into these debt markets. So yes, Colin, I agree. They do find themselves in a tough spot. On the flip side, you're still seeing emerging market managers looking to add additional capital to their African portfolios.
That's very encouraging. As a U.S. government agency, of course, we're also we're trying to find more U.S. LPs, well, the private equity space, obviously, but to generate interest in Africa as well as other emerging markets. I think we better wrap it up. I think lunch is waiting for you all, but I want to thank all of you for listening to us, your kind attention, and thank you all panelists for a wonderful presentation. Thank you very much.
Doing business in Africa. You can't afford to be without Africa Investor.